Hello, everyone. Welcome to another webinar by Smartkarma. I'm Michael Tegos. Today, I'm happy to welcome back Analyst Kyle Rudden, continuing his series on ESG investing in collaboration with SGX. Part 7 in the series explores the current state of sustainability ESG reporting, the importance of global standardization, and what the future holds for the sector. Kyle, welcome back to the webinar. You can take it away at any time.
Great, thank you. Good evening, everyone, and as always, thank you for participating. This is, as Michael mentioned, the 7th in an 8-part series covering various ESG investing-related topics. This one being recent trends towards a single unified global ESG reporting standard. I'll get into that in a second. First, a quick introduction, and followed by just a quick review of what we'll be covering, the agenda. We've done this before, so many of you have probably heard this, but I'll be quick. My name is Kyle Rudden. I cover sustainability and ESG investing on Smartkarma. Prior to joining Smartkarma in about 2019, I was involved in various aspects of ESG investing, predominantly company-specific ESG investment research, but also creating ESG equity indices and developing early stages of ESG reporting standards with GRI and SASB, although as we will get into, a lot has changed since then. I've been covering ESG specifically for about 12 years, 13 maybe now, losing track. But before that, I was in more traditional investment research, mainly as a sell-side equity analyst and head of JP Morgan's Global Energy Research Group, covering big energy, but also alternative energy, new energy technologies, that kind of thing. I'm going to cover three other, aside from the Q&A session at the end, the content of this webinar in 3 sections. Kind of the first 2 are the bulk of it, and the third will be a really brief section. So first, just putting everything into context, ESG reporting standards as being part of what we've covered in the past webinars as the ESG data problem, then talking about trends towards a unified global reporting standard, one in particular, and then maybe just kind of broach a few potential downsides to moving towards a single global standard. The problem, too many chefs in the kitchen, as it were, too many reporting standards. And as I said, it's part of what we have talked about in the past as the quote unquote ESG data problem. ESG data has been the main subject of 2 webinars, and it's been broached in several others in various contexts. And in those discussions, a central theme has been what we've called the ESG data problem. It's not one specific problem per se, but rather kind of a catch-all phrase for a group of interrelated problems. And it's not a constant group either. It's a group of interrelated problems that have been evolving over time. So I talked about one of the last couple of webinars. I talked about the evolution from a problem of quantity to one of quality. Years ago, not having enough ESG data to having almost too much of it. And it isn't so much that we have too much of it, it's that we have too much of it that is inconsistent, incomparable, et cetera, and so forth. Really, the quality problem stems from company reported data issues that manifest in a number of ways, but the 4 big ones, and the ones we've talked about in the past, are kind of inconsistent disclosures, right? The landscape is still, the reporting landscape is still largely voluntary. There have been major changes in mandatory reporting, but still the majority of the world's publicly listed issuers are not subject to mandatory reporting, or they're subject to kind of called partial mandatory reporting. But the point is that currently globally, there's a patchwork of reporting that really results in just inconsistent disclosures. Big patches regionally where companies generally don't report, and inconsistencies across companies that do report in terms of the actual reporting itself. And then the metrics within the reporting are still largely incomparable for a variety of reasons. Again, getting back to limited regulation and multiple reporting standards being primary, but in many cases, you're looking at what should be, or reports to be, or should be the same ESG data that isn't, for whatever reasons. And I'll get into a couple of them later, but I mean, prime example are ESG emissions and frameworks that differ in their approach to materiality, financial materiality versus impact materiality, which is something I'll get into in a second. Another one is a timeliness of ESG data, and predominantly ESG data updates, right? This is still an issuer-reported, ESG data is still dominated by issuer-reported ESG data, right? That's the source, the ultimate source data for everything else in the ecosystem that's derived from company-reported ESG data, such as ratings, rankings, indices, and that kind of thing. So company-reported ESG data has a timeliness issue. It's still very backward-looking. It's getting a little bit better, but still very backward-looking. And more importantly, it's updated infrequently. In many cases, annually, with the annual sustainability ESG reports or integrated annual reports. And occasionally, if you have a really proactive company, you'll get like quarterly data supplement updates. But even quarterly doesn't quite cut it when we're talking about ESG investing and when markets move in real time, certainly not quarterly. And the other category is kind of a catch-all, greenwashing, inherent biases, data gaps, et cetera, and so forth. Voluntary self-reporting or mandatory reporting with kind of light regulation and oversight tends to lead to selective disclosures, and in the worst cases being greenwashing and kind of a relatively new term, green hushing. So greenwashing being making things sound more sustainable or green than they are, and green hushing is when companies kind of conveniently don't mention things that make them look bad. And this isn't, although quote unquote greenwashing, green hushing are pretty prevalent, you really need to differentiate between by motive, right? A lot of it is, there's some of it, but I think rare that's intentional, but most of it is sort of innocent and inadvertent. One thing I've noticed, for example, as a lot of Asian countries sort of come up the ESG curve rapidly, and it is a learning curve, there seems to be this morphing of what were traditionally corporate social responsibility reports into sustainability and ESG reports. So that there are a lot of highlights and emphases on good corporate social responsibility and doing good for the community, et cetera, and so forth. And as such, because that's a big part of the focus of the report, the ESG data reporting stuff tends to get diluted, and it can come across as green hushing or hiding things, but it really isn't intentional or inadvertent. Anyway, these are 4 common areas of problems related to company reported ESG data. If company reported ESG data, being the ultimate source data, is the root of the ESG data problem, so to speak, the roots of the root problem, if we take this logic a little bit further, are 2 things. ESG reporting standards, right? Again, there being too many of them. Just the proliferation over the years of voluntary standards, the big ones like GRI and SASB, topic-specific ones like climate-specific ones like CDP and TCFD, and then niche or sector-specific standards like GRESB and Foundation for Responsible Palm Oil, whatever it's called. Just this proliferation of ecosystems has created a situation where there are just so many standards, often conflicting, different definitions, different approaches to materiality, and it really kind of exacerbates the quality issue. And that's going to be the focus of what we're talking about. But another issue that's very related is reporting related regulations. Historically, a general lack of regulatory oversight of standards themselves, but also peripheral issues such as auditing and assurance of sustainability reporting, like emissions. That's currently unregulated, and the big accounting firms are doing a lot of it, but they're not necessarily experts in emissions, that kind of thing, which I'll address towards the end. But the focus here is kind of the too many standards and the movement towards kind of one uniform standard, which has picked up pace pretty recently and pretty significantly. The problem historically, aside from the fact that there are just too many standards, the main one has been the issue of materiality. The core issue of materiality is the way that differing views on materiality has created a problem can be summarized by a comparison of 2 approaches to materiality. And this addresses double materiality, which is really the convergence of the 2 types of materiality I'm addressing now. The problem in the past has been that certain frameworks or reporting standards approach materiality from a financial, as define materiality as financial materiality. So they approach it from an investing perspective, that things that are material, ESG data and metrics that are material, are those that would affect a company's financials and thus investments in their securities. Whereas societal materiality, sometimes called impact materiality, is more about, and this is GRI, more about how a company's ESG profile affects the outward world. In other words, how what the company does affect climate or society, et cetera, and so forth. And that issue has been really kind of the core of the problem created by too many metrics. And some others like TCFD are also financially focused on financial materiality, and a few others are focused on impact materiality. Kind of the solution to that problem is moving to one global standard for ESG reporting, but that's a lot easier said than done. I can't remember which webinar, but during the Q&A of one of the past webinars, someone asked a very poignant question. It was something like, I can't remember exactly how they worded it, but something like, when do you think we will see a global reporting standard? And I can't remember the exact wording of the question. I can't remember my exact answer, but the gist of it was twofold. I said that I am more optimistic, and this is going back a few months, that I'm more optimistic than ever that we're headed in that direction, but that I don't, at the time, I didn't see us actually getting there in terms of getting to one unified standard, for at least a few years. And fortunately, since then, there have been a few events that have certainly made me more optimistic that we're on the right path, but also that we could get there a lot sooner than I initially had thought we would. I just wanted to point out how the move to a global reporting standard or small set of global reporting standards is universally relevant. In other words, it really is relevant to every investor, in fact, to many stakeholders, regardless of whether or not they have a global focus. Investors, companies, and various other stakeholders like NGOs and so forth, will all benefit from a single or close to single standardized language of ESG reporting, regardless of whether the focus is global or not. Just kind of a unified language of taxonomy goes a long way. But most issuers, even quote unquote local companies, have very global supply chains. The risks that they face from global warming and climate change are very global in nature, right? And almost all companies in one way or another rely on or in the global capital markets ecosystem. And climate change mitigation, adaptation, and sustainable development in general, but UN Sustainable Development Goals in particular, all require kind of a global mindset and global approach. So the move to a global set of standards is really universally relevant, regardless of the degree of someone's global or international focus. This is something that has, this trend towards a global standard is something that has really just picked up steam. The end, if you see all the like IFRS, ISSB, that's going to be the focus of this. But I really first wanted to kind of put this trend into some historical perspective. Calls for a global reporting standard go back years, particularly on the part of investors. I mean, many, many years, but progress towards that end, particularly amongst standard setting organizations, is a relatively new phenomenon, really just the last year and a half. Very early on, there seemed to be plenty of room for multiple reporting standards and frameworks, probably for a couple of reasons. One, the big frameworks like GRI and SASB appeared to be complementary, and in many ways they still are. But when fewer companies were reporting ESG data, the complementary nature of those standards were obvious, whereas the problems that they created were not yet so apparent. But over time, they become more apparent, and investors and other stakeholders realized this and started calling for greater standardization of ESG reporting standards globally. But like I said before, until recently, standard setting organizations kind of didn't listen or didn't care. In fact, there was a pronounced and almost counterproductive feeling of competition, right? It seemed like they all saw the writing on the wall, so to speak, that there was this movement towards, if not one standard, a small set of standards. But they all spent a lot of time arguing about who should survive and why. But that is until recently. And the until recently is marked by the first event in this timeline of major milestones towards global standard. And again, this is far from exhaustive, but a few key events and milestones to kind of put everything in context. The group of five really was, again, just a year and a half ago, really kind of the first event, if you will, first substantive event towards a global standard. 5 leading ESG standard setting organizations made a first of a kind announcement. By the way, those were Carbon Disclosure Project. It's currently just goes by CDP, but formerly Carbon Disclosure Project, Carbon Disclosure Standards Board, GRI, the International Integrated Reporting Council, and SASB, which subsequently merged. But I'll get into that in a second. They announced a shared vision for a comprehensive and standardized set of ESG reporting standards, global, and they agreed to work together towards that goal. Ultimately, this didn't go anywhere due to subsequent events, but it was important in that it marked the beginning of kind of a public recognition of this trend, and it was an indication of things to come. Shortly thereafter, just a couple months later, SASB and IRC announced a merger agreement, which was closed sometime in 2021, to create the Value Reporting Foundation, VRF, which is a name that never really caught on. Everybody kept referring to SASB, and there's a basic reason for that. This was the first genuine consolidation of standard settings organizations, but it wasn't really a consolidation of the standards themselves. And in all honesty, it was hard to make strategic sense of this announcement, because in the announcement, they stated that IRC and the SASB standards were to be kept separate. Again, it's another event that ultimately amounted to little more than a press release, mainly due to subsequent events. But it's significant in that it was the first formal consolidation of at least standard setting organizations, if not standards. The big one, though, is what came out of an announcement during COP26, which was the UN's International Climate Change Conference that took place very late October through early November of last year. Basically, the International Financial Reporting Standards Foundation announced the creation of ISSB, which is the International Sustainability Standards Board, whose primary goal is to move the world towards a global set of standards for ESG, sustainability and ESG related reporting. And a big part of that was the consolidation of SASB, or the Value Reporting Foundation, and the CDP, Carbon Disclosure Standards Board, into the ISSB framework. So it's not just the creation of a new standard, but it's further consolidation. Then, shortly thereafter, I think it was in March of this year, there was an announcement that might not seem like anything, but it's pretty significant. It was an agreement, basically the announcement of collaborative agreement between ISSB and GRI. And why that's important is because GRI was kind of one of those holdouts, really taking a defensive stance and protecting its turf, if you will, putting out some press releases that were really negative about the ISSB for a while. But last month, ISSB and GRI came to this collaborative agreement, which does two things that are pretty significant. One, it settles the turf war, and the turf war is about materiality, which I'll get into in a second. But it basically divvies up two kinds of materiality, if you will. So ISSB is getting financial materiality, and the GRI standards, in collaboration with ISSB, is supposedly going to be the global standard for impact materiality. And that agreement, I think what's most significant here, suggests the future being a kind of two-pillar or two-pronged approach to a global standard or a set of global standards, which I'll cover more in the next slide. And then just on this timeline of major events, very recently, just a couple of weeks ago, ISSB published the first drafts of two standards or categories of standards. One being general requirements. I think the formal title was General Requirements for Disclosure of Sustainability-Related Financial Information, and the second one being more specific to climate-related disclosures. And The first one is predominantly based on SASB, and the second one predominantly based on TCFD. So who is this ISSB as the apparent winner in the race to be called the global standards setter? As I mentioned before, it was announced by IFRS. They established ISSB, didn't establish it at COP26, but they announced it at COP26. They consolidated, as part of the announcement, they consolidated basically what's left of CDP and what was left of SASB and IRC, right, the Value Reporting Foundation, rolled up into ISSB. It did not officially yet, but I think mid-2022 is the target date. And then published the first drafts of global reporting standards, which are dense. So I still have to get through all of them, but the gist of it is that they're basing the general requirements on the SASB standards. I put VRF in there, but ultimately it's the original SASB standards, possibly with the SASB's been in the process had been in the process of updating those standards prior to the merger with VRF. It's possible that ISSB is incorporating some of the new stuff that we haven't yet seen. But the gist of the general requirements is based on the SASB standards, while climate-related disclosures are based on TCFD. Both SASB and TCFD, and thus all of ISSB's standards, are based on the concept of financial materiality. I'll address the impact materiality in a second. ISSB has been, I put endorsed in quotes because that's a dangerous word, but effectively endorsed, or at least supported by many other organizations globally, not the least of which is IOSCO. And it's really been solidified as the standard setting organization in charge of this trend towards a global standard. I can't see that changing, to be honest with you, particularly given that CDP and SASB have been rolled up or will have been rolled up into this thing by mid-year, just a couple months away, and also the event with GRI. As I said before, GRI had a really negative reaction initially. A lot of press release, sort of. The issue is that ISSB kind of, in its early announcements, laid claim, if you will, or purported that it would be both a global set of standards that was both that focused on both financial materiality and impact materiality. And GRI was pretty quick to jump on it, stating that it couldn't be both, and the GRI standards were the de facto for impact materiality, et cetera, and so forth. Eventually, the two of them kind of settled their beef, if you will, the turf war. They came up with this collaborative announcement. Basically, the gist of it is that ISSB's purview of S1 and S2, the general standards and the climate standards, are the ones for investors, if you will, based on financial materiality, and the GRI standards in collaboration with, and I don't know how they're going to integrate them, but the GRI standards are looking to be the de facto global standards for impact reporting. So again, I don't know how this agreement didn't get into details on how GRI standards, or if at all, they will be rolled into ISSB, or if we're looking at two sets of standards as the quote unquote global standard, which is certainly better than where we're starting. That remains to be seen. That's that last ball. There's some uncertainty how this will work in practice. But the key points here are that ISSB is kind of the apparent winner. It's in charge of ushering the world towards this single set of standard or single set of standards, and somehow GRI is going to play an important role in that. Whether or not it's separately or also consolidated into ISSB remains to be seen. Another important issue, although not the main focus of this, but is reporting related regulation. Standards and standard setting organizations are, I would say, kind of 80% of this, and the other 20%, just ballpark, has to do with reporting related regulations, and it takes various forms, but these are important trends that complement and facilitate the move towards a global standard in reporting. An important one are stock exchange-led initiatives, kind of taking the lead in shifting the world from a predominantly voluntary reporting situation to hopefully predominantly mandatory ESG data reporting. Singapore Exchange and Hong Kong Exchange for Asia Pacific are two primary examples, but not the only ones. The major exchanges in the US and Europe are doing similar things. Likewise, securities regulators, most recently the US SEC, as well as securities regulators organizations like IOSCO, are really stepping up in terms of reporting rules and oversight, in terms of mandating ESG disclosures, but also regulating various aspects of disclosures. I mean, a key trend and issue is tackling, labeling and vernacular to combat greenwashing. I mean, one example is in the UK, the Competition and Markets Authority issued I forget what they called it, was something like a green claims code. It basically, setting out a bunch of points to keep companies in check, if you will, in terms of their claims and avoid greenwashing or other inaccurate reporting. And then there's this whole set of reporting-related regulations on the periphery, if you will. Issues relating to regulation of ESG ratings, credit rating agencies in ESG, indirectly ESG indices, and most significantly, what is a rapidly growing field, but vastly unregulated field of ESG assurance, ESG data auditors and assurance providers. One thing that's becoming very important and is a particularly important thing to have to kind of allay concerns of greenwashing and inaccurate ESG data is what's called sustainability assurance or ESG reporting assurance. But basically, you have an auditor right now. The major ones are the big accounting firms like PwC, EY, et cetera, and so forth. Where you have auditors basically auditing sustainability reports, either in whole or parts of them, like ESG emissions, GHG emissions, and providing third-party, independent assurance, which is supposed to give investors confidence that the data in the reports are accurate. The problem, or the potential problem, is that this is an unregulated field, and there are absolutely no requirements, certifications, et cetera, and so forth. Pretty much anyone could set up shop as an ESG or sustainability report or data auditor and sign off on these things. So there's a pretty significant movement afoot by regulators to lay down the law, if you will, on this growing trend, this growing field, and really set some legal definitions for things and define how ESG emissions should be calculated. I mean, there are a number of standards regarding just calculation of ESG emissions. The GHG protocol is the leading one, but there are several of them. So this is also a pretty significant area. Again, reporting related regulations are just a small piece of the equation here, but without them, that move towards a single standard ESG reporting, single global ESG reporting standard, or a small set of ESG standards is almost impossible without the support of this kind of regulation. The potential problems or pitfalls of this move to a global standardization. This isn't going to be detailed, but just some thoughts that I had when thinking through this. One of them, the first one, I'll just read it and then tell you why I regret putting it there. ESG restatements, quote unquote restatements, right? Just how we occasionally see restatements of financials, earnings, et cetera, and so forth. We might see, a restatement of ESG data, sustainability reports in whole, or individual segments of sustainability reports, such as greenhouse gas emissions. The more I think about it, the more I think this is less of a universal risk. It may still be a risk here and there, but given that ISSB's general reporting framework or standards, at least according to the draft, is predominantly based on SASB, and its climate-related disclosures predominantly based on TCFD. I don't think this is as big an issue as maybe I initially thought, but it still exists. It could potentially uncover reporting inaccuracies that could be a big deal for certain stocks. The bigger issue, though, is if there are sort of restatements or reclassifications, redefinitions of standards, even of the SASB standards or TCFD, that could make some historical comparisons a little difficult unless companies go back and restate historically. But I think the bigger issue, and in hindsight, I would have left this one out, And I probably would have put as a bigger concern the potential perpetuation of what I'll call SASB-related reporting problems, and not just SASB, but the reporting problems associated with financial materiality. And one of them is that the SASB standards were created a long time ago. They haven't been updated. We're going back like 5, 6, 7 years now. And because it's based on financial materiality, you get some awkward situations where there aren't any, or there are very limited greenhouse gas emissions disclosure requirements for certain sectors, predominantly financials, for example, because at the time, SASB didn't think that greenhouse gas emissions were financially material to financial services companies. The requirements basically non-existent. I don't want to say long before, but in the early stages of thinking about climate-related financial risks and thinking a lot about scope 3 emissions and the portfolio emissions or financed emissions. So I think that's a bigger issue. Again, it remains to be seen exactly how all this shakes out with ISSB. But if they don't include some of the draft updates that SASB was working on, and or don't work with the SASB standards to be more up to date, if you will, the bigger concern, rather than ESG restatements, is just perpetuation of past problems with SASB, but generally financial materiality standards in general. Another potential issue is modeling compatibility. It's more an issue, I think, for firms that are heavily invested in this, but talking about like sustainability and ESG thematic models or integrated models, models that integrate ESG data and financial models, valuation models, that sort of thing, and even some portfolio level stuff that factors ESG into the equation. Again, it remains to be seen exactly how things change, but if they just kind of rewrite the standards a little bit, or even change some of the standard identifiers and codes that could cause a bit of a headache. Nothing that can't be fixed, but a bit of a temporary headache. And then downstream, depending on what exactly ISSB does and what the standards look like, there could be effects on the greater ecosystem, right? There's this whole third-party ESG data and product ecosystem that is based off of company-reported ESG data. So if you start tinkering with and changing company-reported ESG data, that has a trickle-down effect on a lot of things, such as ESG ratings, scores, rankings, the stuff that you get from MSCI, Bloomberg, et cetera. Sustainability and ESG related, well, not just equity indices, but market indices, predominantly equity, but there's some fixed income indices too. And a whole host of index linked and just general ESG related investment products, mutual funds, ETFs, derivatives, et cetera, and so forth. Again, remains to be seen. Not saying that any of this stuff will shake out or come to fruition, but really just food for thought that while this move to a global standard for ESG reporting is, hands down a good thing. It's something we've been waiting so long for. There's no question about that, but there's always a little yin with the yang, and there's some potential downsides. And this is just kind of like preliminary food for thought more than anything. The last webinar, I apologize to anyone that was on it. I realized afterwards we went way over time. So I was sure to kind of keep this one a little economical on time side, perhaps even erring on the side of caution. I wanted to leave plenty of room at the end for Q&A, which is what we can move to at this point.
Thank you very much for this, Kyle, and thank you for the concise presentation. Maybe we can give it a minute for any questions to come in. I guess in the meantime, Kyle, I wonder, there seems to be obviously a bit of a growing pains situation for the market to go through it in order to achieve a global standard. In your experience, how do companies themselves view this? Like, does it seem like they feel it's worth going through these growing pains in order to achieve this global standard?
Well, I think it's a twofold answer. I think that the vast majority would say that they welcome global standardization, simplicity, et cetera, and so forth. Then they might disagree on whether or not that global standard or small set of global standards should be predominantly based on financial materiality or what we call impact or societal materiality, or some combination thereof. And it seems like, as I said before, with the collaborative agreement with GRI, that this sort of global standard or small set of global standards is kind of taking a two-tier approach. And I don't know if that two-tier approach is one set of standards is based on financial materiality, right, ISSB, and one is based on impact materiality, GRI. It's a little better than where we are, but it doesn't really fix the problem. You still have two very separate standards that can cause problems with reporting. I mean, if a company reported solely based on GRI, its ESG data is going to look very different than if it reported based solely on SASB or any financially material based set of standards. So there's no question that the majority of companies they want simplicity. I mean, that they're reporting based upon right currently major standards like GRI and SASB, but also the Sustainable Development Goals, which are kind of a quasi standard, TCFD, and then a whole host of industry or sector specific standards like real estate and real assets, GRESB, which is a major one. But then there are kind of sector for palm oil. There are a set of standards for palm oil and a whole host of industry or sector specific standards, and it's just too much. I mean, it's a headache for even large companies, and it's extremely costly for a lot of small and medium companies. So no question they want to go towards simplicity, but I think they would differ on if it's one or the other, right? Like GRI or and impact materiality, or ISSB and financial materiality. I think they would disagree. If what we're looking at is more that concept of double materiality in that earlier slide, which is a blend of or considers both financial materiality, impact materiality, that's a bit better, and that is consistent with one kind of global standard, and I think most companies would agree with something like that. And companies being issuers, but investors as well. The same thing applies for other stakeholder groups.
Absolutely. Efforts by ISSB and GRI notwithstanding, do you think it's likely that exchanges themselves will sort of step in more and more and kind of lead the efforts of standardization?
Yeah, well, not necessarily standardization per se, but disclosure. So as I said, the kind of big category of, I say, quote unquote, reporting related regulations. I mean, some are true regulation, like the Securities and Exchange Commission in the U.S. is proposing. Others are related regulations. And one significant one is stock exchanges taking the lead on mandating sustainability and ESG reporting and disclosures. They are effectively telling companies that were previously on a voluntary reporting basis that you're now required to report. They may tell them kind of what kinds of information they're required to report, but ultimately, the reporting will be based on one of these standards, right? So in many cases, an exchange will say, okay, you need to start reporting sustainability and ESG information. It's up to you whether you want to use GRI, SASB, et cetera, and so forth. So the two are related but different. So exchange initiatives are really about mandating some form of reporting, and that reporting will be based upon one or more of these initiatives, one or more of these ESG reporting standards, and hopefully ultimately a single standard. But exchange initiatives don't really set the standards per se. They only mandate disclosure.
Thank you very much for that. If there are no other questions, we can wrap this one up. Thank you, Kyle, for your presentation, and thank you to everyone for attending. And of course, thank you to SGX for collaborating on this webinar. If you want to engage Kyle more for bespoke research requests, you can do so through contacting your Smartkarma account manager. And you can follow Kyle's profile on Smartkarma so you don't miss any of his insights. We will be announcing the next and final part of Kyle's ESG investing series soon, so stay tuned for that. And we will be, of course, linking the previous sessions on the registration page as well. If you have any other questions or comments, please email us at research@smartkarma.com. Kyle, thank you very much once again.
Great, thank you, everyone.